Medical Properties Trust stock, ticker symbol MPW. This stock is down almost 27% on the year-to-date chart, while the overall market, in this case the S&P 500, is up roughly 8%, so that's a big difference. On the 27th of April, MPW presented quarter results where they missed on FFO and revenue by a small margin. But most people only care about the dividends. And right now dividend yield is at 13.8%, which is of course an insane number. They grew the dividends for 10 years in a row, which is also pretty impressive. But does this mean that MPW stock is a buy at current prices? Well, in this video I'm going to show you real quickly what MPW does. The most recent earnings report, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does MPW do? Medical Properties Trust is a real estate investment trust that invests in healthcare facilities subject to triple-N leases. When we dive in the most recent earnings report, we see that MPW reported a net income of $0.05, which is not looking that great. But FFO was reported at $0.37, and to me this is very important since REITs use FFO to pay out the dividends. MPW declared a dividend of $0.29, so these dividends are covered very well, giving us a payout ratio of 78%. And in here we see that net income is down from 631 to only 32, but keep in mind this is because of the real estate impairment charges. Funds from operations is also down big time, but it's looking way better than the net income decrease. FFO is down from $0.47 last year to $0.31 this year. So this is something that worries me a bit, same as the net income. Normalized funds from operations is down from 0.47 last year to 0.37 this year, highly impacted by this year's write-off on milled rent. So keep that in mind. A very important metric to me is the net debt to EBITDA. I prefer a range of 5 to 6.5. And in here we see that it is at 7.2, so this is way too high. To me, a red flag. Debt is at an unhealthy level. If we dive in more the company itself, we see that right now MPW has 444 properties within its portfolio and 54 operators in 31 states and 10 countries. To me this looks pretty diversified, but keep in mind that they are only focusing on the healthcare sector. Roughly 86% of these properties mature after 2032, so this looks pretty good to me. They have a solid diversification here. And in here we see that the revenue by asset type. General acute care hospitals is representing 68% of the total assets and 72% of the total revenue. So this is by far the biggest segment and doesn't look really diversified to me. Behavioral health facilities represents 15% of the total revenue. And the third biggest segment, inpatient rehab, represents 8% of the total revenue. The individual facility diversification on the other hand looks pretty good, with the biggest tenant only representing 2.6%. The biggest operator is Steward Healthcare, representing 13.5% of the total revenue. It's not too bad to be honest. Right now the US represents 66% of the total revenue, and the second biggest country is UK, sitting at 24%. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. MPW is a 5 billion market cap company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO instead. Right now it's sitting at 6, which is a really low number of course. Later in this video I will show you my 3 price targets for MPW, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.48 billion, and in this graph we see that revenue went up quite a lot in the long run. However, there are two interesting things happening here. The decline in revenue in 2019 and the current decline. Can the MPW turn the tide and increase the revenue again? This is one of my main questions. And to be honest, I think they are in trouble right now. Margins are going up and down over a longer period of time. But most recently, margins have decreased big time, so this is something that I don't like. EPS is obviously following the same trend, but for a REIT it's pretty okay, except for the most recent quarters of course. And we see interesting things happening and the analyst estimations. For the EPS it's expected to take a big hit. Revenue is also expected to grow at really low numbers, so to me these expectations don't look that great and worry me a bit. Return on assets is sitting at 3.1%, which is below my 10% minimum. But for a REIT it's pretty okay. Return on equity it's not looking that great at 3.5% and does worry me. And the most important number, return on invested capital, is sitting at 3%, which is not the highest of course. On top of that it's lower than the 5-year average, which is something that I don't like. Current ratio is at 2.15, which is too high in my opinion. I prefer a number between 0.5 and 1.5 for this type of company. But it has to be said that I was expecting higher numbers here, so it doesn't worry me that much. Total debt is sitting at 10.4 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 302 million, so they can't pay down a big chunk of their debt, which is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up over a longer period of time. The two spikes are a fluke in my opinion, so I expect free cash flow to return to normal growth numbers. Another thing that I think is very interesting about this company are the shares outstanding. It's going up in the long run. REITs issue new shares to grow the business, so I don't mind that much. Next up are the dividends. Dividend yield is sitting at 13.8%, which is a great number of course. Annual payout is at $1.16 and parent ratio is at 78%, as we saw earlier in this video, and not the 156% displayed here. The average for REITs is around 75%, so it's not that bad. Right now they have roughly 22% left in cash to buy back shares, pay down debt, acquisitions, research and a lot of things. The 5-year compound annual growth rate is at 3.6%, which is a decent number for a REIT, and they grew the dividends for 10 years in a row. Overall these dividends look pretty good to me, but does this mean that MPW is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 0, 2 and 4%, since I think they will increase the revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 22%, 24% and 26%. And for the free cash flow margin I'm filling in 37, 39 and 41%. For the PE ratio I'm filling in 20 since this is a REIT and PE ratio isn't a fair metric to use. For the price to free cash flow I'm filling in 10, 11 and 12. It's a slow growing company and not all fundamentals look that great. So I don't want to overpay for the growth and there is no big moat or anything. My desired annual return is 15% since I can get an easy 10% average annual return with owning an ETF. Usually I take 12.5%, but I want to build in a higher margin of safety. Right now MPW stock is at $8.4. I hit analyze and we see a few green numbers. And since this is a REIT I will only focus on the discounted cash flow value and not the multiple of earnings value. We have a low price target of $6.87, a mid price target of $8.5 and a high price target of $10.5. To me the mid price target is the most justified here, indicating that they are fairly valued based on these numbers. My final conclusion is that I get why people like this stock. They pay an insane amount of dividend and that can be very attractive. However, I do think the risk is too high with this company. Because revenue is declining, debt is too high, they are not very diversified in terms of industry focus, and margins are decreasing as well. Right now the dividends are covered, but I do think it's a matter of time before this company will fall down big time. It's already down 26% this year, and I wouldn't be surprised if it will fall down even more. I think I will avoid this stock for now because of what I said a second ago, and I will analyzing them from time to time to see if fundamentals have changed. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.